Hello friends, welcome to my channel. In this video, we are going to do the stock analysis of a company which is creating a lot of buzz these days in the news and whose stock has given tremendously unbelievable returns in the last few weeks. And you've guessed it right, it is Borosil Renewables. It's the stock which you have chosen in the poll conducted in the Telegram channel. Before we begin, if you have not subscribed to my channel, please do subscribe and consider joining the YouTube community where we are discussing a lot of stock specific analysis, news, views and a lot of interesting stuff. And do follow me on Telegram and let's get started. Before we begin, let's understand what is a monopoly, because there's a lot of discussion in the media about this company having a monopoly in its product and its sector. So by the end of the video, you will realize whether this company really has a monopoly or not. So monopoly, when a company is considered to be a monopolistic company, we see that that enterprise is the only supplier of that product in that particular region. And then there is no competition from other sellers. The product is unique and it doesn't have any close substitutes of other products. And there are barriers to entry for others to start the same business. And that sole manufacturer has the power to set the price and charge a decent price or whatever price it wants to charge, as it is the only manufacturer or supplier of that product. So if these situations arise, generally it is considered to be a monopoly. Now let's understand the introduction. Borosil Renewables is India's first and the only solar glass manufacturing company. It has started this solar glass business in Gujarat in 2010 January. It is into the glass business from quite a long time, but they started the solar glass business in 2010 and it has a capacity of about 2.5 gigawatt per annum presently. Earlier its name was Borosil Glassworks Limited, which was changed to Borosil Renewables Limited, and it has a glass manufacturing business of industrial and consumer products also, which we use in our daily life like tableware, kitchenware, etc. And that was recently demerged into another company called Borosil Limited, which is separately listed on the stock exchange. As on March 31st, 2020, there's no subsidiary of this company, and this company has sales in India as well as abroad. The management of the company is being headed by Mr. P.K. Keruka, who is the executive chairman of this company, who is into this industry for more than 4 decades now. So he has quite a good amount of experience in glass manufacturing. He's an undergraduate from St. Xavier's College, West Bengal, and this is a family run business, and his son, Mr. Shrivar Keruka, has also joined his father in running the glass manufacturing business. Let's understand some milestones of this company. In 1962, they first started the glass manufacturing business. It started as a public limited company by acquiring another company called Industrial and Engineering Apparatus Company Private Limited. In 1991, Gujarat Borosil was set up to manufacture architectural glass. In 1999, they started Borosil International, which was into a special line of products into consumer glassware. In 2008, Viline Glassworks was started to manufacture laboratory and consumer glassware. In 2010, Gujarat Borosil started manufacturing solar glass production line. So in 2010, they entered into the solar glass manufacturing. In 2013, they developed anti-reflective coating for solar glass. So this was one of the major innovations which was done in 2013. In 2014, again an innovation came in where they developed world's first anti-money free solar glass. In 2017, again they innovated a 2 mm thin solar glass which was first manufactured by this company in the world. So you observe that this company has been focusing on innovating and manufacturing newer products faster than the global competitors also, which is a good aspect of this company. In 2018, Viline Glassworks and Hopewell Tableware got merged into Borosil Limited. In 2020, there was an amalgamation restructuring of the group, and Borosil Renewables took over the business of solar glass manufacturing and Borosil Limited took over the business of industrial glass and consumer glass manufacturing. So if you see now, the group structure is Borosil Limited is doing consumer industrial glass manufacturing, Borosil Renewables is doing solar glass manufacturing. This company has a very simple business model. They are into manufacturing of solar glass. Solar glass is used to manufacture solar modules, which in turn are used in setting up solar units. The sales are domestic in India as well as exports. They are very much focused on innovating newer products and optimizing their cost, as the management says that they are having one of the least costs of manufacturing solar glasses in the world. And in India, obviously, this is the only company doing this, so they are market leaders. If you see the revenue by geography, exports constitute about 23%, and in India, domestic sales are about 77%. Now let's understand some developments in the market and the industry in which this company operates. This is a Chinese dominated market globally, and the Chinese factories produce the maximum share of the solar glasses in the world. The Chinese manufacturers, when other countries like India are using anti-dumping rules to restrict the imports from China, the Chinese manufacturers cleverly are setting up new companies or investing in companies based in Malaysia and Vietnam and creating manufacturing hubs there and selling those products to India and other countries from there to overcome the anti-dumping duties levied by the countries. The government of India has certain targets to promote the solar installations, which is good for the industry and this company. In India presently, the total installed capacity is of about 35 gigawatts as on April 20, which is the targets are much higher which of expansion into India. Other than the China, if you see global share, although China has the major share, but still the other countries are increasing their share globally when compared to the China manufacturers now. And as we discussed that the solar glass is used to manufacture solar modules, a lot of companies, instead of manufacturing modules in India using the solar glass, they are directly importing the modules from abroad, which is a negative for this company as they are into selling glasses. The government of India, as we have discussed, has a plan to expand the capacity and set up around 100 gigawatts capacities by 2022, which is a very good sign for this company. There are no specific competitors in India, so if we see, they have tough competition from Chinese manufacturers, Malaysian manufacturers and Taiwanese manufacturers. What are the different competitive advantages which this company has when compared to the other global players? As we have discussed, this company claims to have one of the lowest cost globally in manufacturing of solar glass, and in India they are the only manufacturer. They are continuously innovating and starting new products. They have good relations with their existing clients, and the management says that solar glass manufacturing is a very complex process and claims that it is not easy for other competitors to enter the manufacturing of this product. So this is the claim by the management in one of their interviews. In times to come, we will see whether it is really complex and whether other Indian players are really not able to start it easily. Now let's understand the growth prospects of this company going further. Recent restructuring has led to focused growth in the two businesses separately in Borosil Renewables and Limited. The existing capacity was recently doubled from 210 metric tons a day to 240. Another 240 metric tons a day capacity was added because they were operating at full capacity. The Make in India movement will support this company's Indian manufacturing a lot, as the government may levy some restrictions on imports and insist the module manufacturers and solar project companies to buy glasses only from India. The government is already started levying anti-dumping duties from the imports, and the company has started manufacturing thinner solar glasses in which they are the first ones to do that, and that particular glasses have a lot of advantages in terms of efficiencies. The company is planning more expansion in the thinner solar glasses, and this company is the first globally to introduce the thin glass, as we have discussed. They have also developed another new product which is glass with anti-soiling coating. They have also developed anti-glare glass for the airports and the areas around the airport so that the flights are not disturbed. Cost wise, the company is having At present also they are having optimization, but they are continuously focusing on keeping their costs lower because the sales price is not there in their control, and they are continuously trying to increase their productivity. Now they are even planning to install a third furnace with a capacity of about 500 metric tons. What could be the possible risks which this company might face? The unfair prices at which the prices are sold, the products are sold by the exporters from the other countries like Malaysia and China are a big risk to this company. There is a risk that other local competitors may start manufacturing the same product where the monopoly may be lost. The company is highly dependent on the government incentives for margins. If those incentives are or anti-dumping duties are removed, the company might face problems. As the Indian government is supporting the Indian manufacturing, the other exporters from the other countries are being supported by their governments by levying subsidies, which is helping them dump the products in India. And sometimes those manufacturers are even ready to take the hit in terms of lower pricing because they have excess capacities and they are dumping that products to India. And the government may come up with some tariff control measures where the selling prices of these products may be controlled, because the government will try to keep the cost of solar electricity manufacturing minimum. So again, on the selling price, this company may face some restrictions. And globally, the different countries may have different tariff wars which might affect this country's margins. As we have discussed, in China and Malaysia, they are having excess capacities, so they are trying to dump the products in India at lower prices. The Indian solar module manufacturers, which are buyers or customers of this product, who are located in SEZs, are not liable to pay anti-dumping duties because the SEZ is considered outside India in terms of taxation. So if they import something from abroad, they are not required to pay anti-dumping duties. So the factories which are located in the SEZ, they are not interested to buy from this company, and they are continuing with the imports. So there is a lacuna in the law which is created, which this company hopes that which may be covered by the government soon. And if you see the order book of this company, it's only 1.5 months. So there is not huge line of orders existing on the financials, which could be a risk. If there is any discontinuance of orders, the revenue might be affected suddenly and drastically. Now, after understanding the business of the company, let's understand the financials part. Starting with the quarterly results, in Q2 of FY21, the revenue was about 114 crores, which is up by 96% when compared to previous year. EBITDA was 32.38 crores, which is compared to the previous year, which is about 5 crores. EBITDA margin was 28%. Profit after tax was 14 crores compared to a loss of 2 crores in the earlier year. Profit after tax margin was 12%. So quarterly results have been pretty good. Let's understand the shareholding pattern. As on December 17th, which is after the restructuring, the promoters have a holding of about 62%. DIA is about 2.6, FII is about 10%, and other non-institutional investors have about 25.4%. Coming to the yearly financial highlights, the revenue for financial year 20 was about 275 crores, which is up by 22% year on year. EBITDA was about 40 crore, up compared to 41.2 crores in the earlier year, so there is a drop in EBITDA. EBITDA margin was about 14.5 crores, and profit after tax was only 45 lakhs when compared to 23.5 crores of the previous year. Profit after tax margin was drastically dropped to only 0.16%. Earning per share is only 0.04 rupees compared to 2.28 rupees in the previous year. ROE is 0.13%, ROC is about 1.90%. So if you see in terms of margins, they are very low, and the return ratios are also very less. If we see the balance sheet of September 2020 quarter, the debts are of about 75 crores. The debt equity ratio is 0.22, which is very controlled. Cash of about 6.5 crores, trade receivables about 53 crores. And free cash flow wise, it is going good, and the first half of financial year 21, the free cash flows are of about 22.5 crores. Coming to the remuneration of full-time directors, it was about 3.4 crores, which I did not like, as the profit were just about 45 lakhs. Statutory auditors of this company are Messrs. Pathak HT and Associates LLP, and there is no dividend paid in financial year 20. Coming to the valuations part, the last trading price is about 231 rupees, 52-week high and low is 27 to 245, so it is almost trading at the highest. 1 year return is about 450%, 5 years about 350%, so the stock has given a drastic return for the lucky shareholders. The market cap is about 3000 crores, PE is about 56 for the trailing 12 months, EPS for trailing 12 months is about 4.12, price book ratio is about 2.66. So in terms of valuations, I feel the stock is pretty expensive considering the performance it has been delivering in the recent few years, as the performance has not been consistent, and we should wait for a consistency in performance to determine the real valuation of the company. We cannot judge it on the basis of the recent quarter's performance. Let's discuss some recent news and announcements. The plants as per the managements are running at their full capacity now. There is about 500 crores expansion newly planned, which is a good news. The capacity from 450 tons a day has been planned to double to about 900 tons per day. They have recently raised money through the QIP route of about 200 crores, and for the remaining 300 crores they plan to raise through debt about 180 crores and about 120 crores through their internal accruals. And the management expects that the margins are going to be better going forward, which is a good sign. So lastly, let us come back to our first point. Does Borosil have a monopoly really? As we discussed, the first condition, the enterprise is the only supplier of a particular product. So Borosil is the only supplier in India, but it faces a tough competition from the exporters from China, Malaysia and Taiwan. So ideally speaking, it's not the only supplier. And there's no lack of competition because it faces tough competitions from the exporters from the other parts of the world. The product is not unique, as there are other suppliers who are supplying the same product. I don't think there are strong entry barriers for the bigger groups to enter this industry and start their own manufacturing plants. And the company clearly says that they are not setting up the price on their own. Although they are the individual and the only manufacturers in India, normally they see at what prices the exporters are selling to India, and they try to set their price a little lower than them so that the other Indian companies buy from Borosil. So it doesn't absolutely have the pricing power. So it is clear that this company doesn't have a real monopoly in this product or sector. So coming to the conclusion, the promoters are experienced in this industry. The company has market leadership in India. They are doing a lot of innovation, which is very good. Operational efficiencies wise, they are one of the lowest in the world, which is a very good sign. The sector is fast growing, so the company will experience a lot of tailwinds. Growth wise, there is a little inconsistency, and the company is facing a lot of competition from the exporters of the world. The margins are pretty less, and I feel there are not many entry barriers to this product or the industry. Valuation wise, I feel it is expensive, and we should wait for the stock to perform, the company to perform consistently, and then come to the real value of stock before investing. So thank you for watching this video. I hope you like it, and do leave your feedback in the comments. Do mention the names of the companies on which you want me to make the next video, and join the YouTube community, subscribe to my channel, do follow me on Telegram, and have a wonderful day.